Welcome back to the Week in Markets. My name's George Bell, Portfolio Manager, and I'm joined today by Chris Leyland, our Director of Investment Strategy. Quite a bit to cover this week, Chris. We could maybe focus on the volatility we're seeing in markets and then across in the UK and some of the key events, if that works. So focus on the volatility. What are the key factors that have driven a little bit of volatility this week?
Yeah, absolutely. So probably the first factor, or the main factor actually, that's been driving volatility is the escalating tensions that have been taking place between Russia and the US. So we saw the Russian president, Vladimir Putin, he amended Russia's nuclear doctrine. So what does that mean? So the doctrine looks at when Russia could potentially deploy their nuclear arsenal. Now, they've been talking about this for a few months, but what's quite interesting is the latest amendments were made within days of a US decision to allow Kiev, so allow Ukraine, to use American-made long-range missiles against Russia. So obviously that has been taken badly by Russia. Furthermore, we've also seen Ukrainian news outlets, so this came out on Tuesday morning, posted that US missiles have been used to attack a Russian military facility. So that's the kind of background, but what's been happening within asset markets. So on that day, we saw what we call safe haven assets. So assets particularly such as, say, gold do well. So gold was up just under 1% on the Tuesday. But I think what was quite interesting is that Russia didn't do anything against the US. And what I thought was interesting there is that actually equity markets, although they sold off initially, they then rallied back. So that to me is maybe a signal that actually investors are a little bit more worried about Russia retaliation. And when that didn't come through, that's why you saw that move back upwards in equities overall.
And was there a move in the oil price?
No, I mean, again, this is really interesting in that normally when you see these type of conflicts, the oil price is actually one of the first assets to move in price. So normally what would happen is there would be nervousness around supply. And then what would then happen is then the oil price would move upwards. But actually, if we look, the oil price right now is actually quite similar to where it was last week. So what's sort of my take on that? Well, my take on that is that investors don't see a prolonged problem. What they see is maybe this to be more of a short-term issue overall.
So we've seen a bit of volatility on the back of the events this week. We've seen a number of these events over the last number of years, and it has resulted in short-term volatility. But what markets tend to be more focused on is the longer-term drivers, the dynamics such as inflation, growth, what it means for central bank policy and interest rates as well. But that was a good summary, Chris. In terms of the UK, quite a bit of data this week, particularly around inflation. Yeah. What are the key takeaways?
Yeah, sure. So as you said, inflation data came out this week. So we saw on an annual basis that inflation has risen. So headline inflation, so headline CPI has increased from the previous month, which was at 1.7. So it's now come up to 2.3%. So it's still, very significantly far away from what we were seeing, say, 2 years ago when inflation peaked at over 11%. As well as that, I'd say, it's also in line with what the Bank of England have been guiding to. So they guided that inflation will come up, and they've actually guided that inflation will marginally increase as we move through the rest of the year. I think where guidance and expectations struggle a little bit is with the energy price cap. So as we move into next year, it becomes a little bit more muddled, I guess, around what the expectations are.
And has there been any delayed effects of the Labour budget in markets?
Yeah, I mean, look, the Labour budget is quite punitive. And what have we seen? So we've seen that the high street and also individual employers, I think that they could, sorry, I don't know why I can do that.
I'll ask the question again.
Yeah.
Yeah. Okay.
Yeah.
Ready?
Yeah, good.
And has there been any delayed effects of the Labour budget in markets?
Yeah, I mean, if you think around the Labour budget itself, clearly the Labour budget is punitive. I think we all know that. It appears that it's quite challenging for the high street. It also appears as well that there is potential for additional price rises to come through. So what you've seen is individual companies say that the higher level of national insurance payments that they will have to make for their employees, the way that they're going to deal with that is to basically charge higher prices for the goods or the products that they sell overall. So I think that's probably point one. I think point two is that I think the Labour government needs to be quite careful. And I'll tell you why I think that. If you've got inflation that is maybe slightly inflecting upwards, again, only slightly, but then, your policies are potentially inflationary, you'll be quite careful around not adding too much fuel to the fire overall. So for me, I think, Labour have quite a delicate path that they need to walk through over the coming months.
I think that's one of the key aspects we've been bringing out on our morning market updates over the last number of weeks. Some of this is going to be financed through tax. Some of it's going to be financed through borrowing, so additional debt. So what we're seeing to fund that is an increase in the number and the value of gilts being issued into the market. And if we think about an increase in supply of anything, it often brings down the price if demand doesn't soak that up. And what we discuss in our morning market updates is the price and the yield of the bonds move inversely for one another. So as the price is coming down, the yield's backing up. And what that means is actually it's a more expensive rate at which the UK government has to borrow. And so what does this all mean for UK borrowing costs?
Yeah, so it's a good question. Obviously, we had the figures came out on Thursday morning. So just reading through the figures in front of me now. So public sector net borrowing, so that excludes public sector banks in the UK. So that increased to 17.35 billion. The previous number, which was September's number, was 16.13. So you've seen quite a big increase there. But I think the key number that everyone is focused on is that expectations were for only 12.3 billion. So you've seen public sector borrowing come in nearly £5 billion higher than what was expected. And if we just think around where borrowing is in the UK, it's actually the highest in the developed world right now.
So you've got two quite interesting dynamics going on there, Chris, which you bring out. You've got inflation, which has moved from below target, so 1.7 versus the 2% target, to actually above. Part of that's the energy price rises, but we are seeing some upward pressure come through from services. And that's a challenge for the Bank of England in terms of what they do with interest rates.
Of course.
Impacts the timing and the magnitude of interest rate cuts, which they can bring through. The market does still expect that we'll see a number of interest rate cuts over the next 12 months, but it just puts some volatility into the gilt market on that. And on the other side, you've got the government who is trying to finance their spending at a higher rate of borrowing as well. So quite a challenging backdrop for the UK, and really demonstrates the importance of being international and multi-asset when you invest.
Yeah, no, you're exactly right. I think, how do we invest? We invest globally. If we look, UK equities are quite a small portion of our whole equity book. And the reason for that is that both structurally and tactically, we believe in reducing single country risk. Therefore, what we want to do is to spread that risk across different regions. And that's exactly what we do. We're a very global manager overall at True Potential.
Excellent. Thank you, Chris. That was a great update. And thank you to our audience for watching and for listening. If you enjoyed the content today, please do like and subscribe to our channel, and we'll be back next week, same place, same time. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.